because we've got to create the flywheel. So you've got to create the usage, and we're in a bit of a chicken and egg. People are saying, "Oh, there isn't enough liquidity, so we can't use it." Well, if you're not going to use it, there won't be liquidity. So it's kind of how do we break that chicken and egg?
This is Money Never Sleeps. Sharp riffs, big ideas, and real insights from smart people. I'm Pete Townsend. Let's go.
Money never sleeps, pal.
So we've got Garrett Cassidy on the show, and it's so appropriate that he is on the show for the new era of Money Never Sleeps. Sharper, faster, video-led, and that this is the first cut of the new era. Now, you're a Techstars alum, you're an exited fintech founder, mentor, advisor, independent director, and also you're one of the first people I spoke with about fintech way back in 2013 when you and Gary Layden dropped into my office to get my take on a fintech accelerator that NDRC were running here in Ireland. So great to have you on. Wonderful to do this first one with you, Garrett.
Yeah, no, great to be here. And to add to all that, I'm recovered from 20 years in financial markets and banking as well. It's like yourself. So yeah,
You've got the scars.
yeah,
Yeah, absolutely. Absolutely. No, we both do. We both do. So listen, you and I have been talking a lot about stablecoins recently, especially last week when we were in Amsterdam for the Techstars ABN AMRO Future of Finance Accelerator Demo Day, which was an awesome event. Shout out to Allard Luxinga for leading the charge with that program. And we had a few conversations afterwards, but you found something that you wanted to pick apart a bit with regards to a story that you saw on stablecoins in the last couple of days. Tell us about it.
yeah. So in the FT this week, Martin Wolf has written a really interesting piece on stablecoins. Really, his headline is why the world should worry about them. But I think that the underlying piece is why the world should worry about US dollar stablecoins, as in the dollarization and what some of those implications are. So some of this can sound challenging and negative, like we need money on chain. We need on-chain money to do tokenization. But I think we need to be honest about some of the challenges that exist. And we also need to be open as to what are the different ways of tokenizing. But I think, Martin Wolf obviously comes from a very long line of deep economic thinking and has a very kind of interesting take on the challenge around US dollar stable coins, and asks some questions as why is the US pushing it so hard and what does it mean for other countries?
Yeah. Why do you think the US is pushing it so hard? And is that political rhetoric or is that the truth of what this could become?
I probably do buy a lot of what Martin is saying, which is this is about geopolitics as much as economics. It's dollar dominance. It's protecting, obviously dollar's already pretty dominant, but it's protecting dollar dominance. Obviously there is the other narrative which is genuine around, US payment systems are old, are slow, are challenging, remittances, are expensive, cards are expensive, much more expensive than we're used to in Europe. But fundamentally, it's like, why is it being pushed? Well, there is a dollarization agenda. There's also a potential underlying US Treasury agenda, borrowing from the world.
I kind of step back from all this and think, you have European sovereignty, right? And to say that if the world is using US dollar denominated stablecoins, and stablecoins have, 99% of stablecoin value is pegged to the US dollar. And what I think about 2/3 of the value, the 300 billion plus now in stablecoin value, is backed by US treasuries. Now we have some other assets that are backing some of the stablecoins, but primarily it's a US treasury play.
Yeah.
Which is great for the US macro scene in one way, shape, or form, and in many ways, shapes, or form. But I just don't see 99% of the stablecoin value being represented by the US dollar when we're at 2 trillion worth of stablecoins.
Yeah,
I just don't see that.
Yeah, and I think there's an interesting one here, and it is one that the article pushes as well, is that the other regulators and central banks need to be careful. And this is kind of an interesting point because Bank of England released some stuff recently, And there is a lot of pushback, and we're all going, what are you talking about? And why are you doing this? And then you realize actually there is a valid reason for sovereignty. And there's lots of challenges with my car in Europe. And one of the ones that gets pushed hard is the limitation on non-euro stablecoins. There's a huge push from some of the big international stablecoin issuers for changes to that. But actually, I think it's one outside of the US. We need to ask ourselves of, is that the right answer? Pete, we've had this conversation many times. We need liquidity in other markets in stablecoins because
We do.
we do, and otherwise, like I think we'll come back to emerging markets, whatever about the use case in emerging markets, which has another challenge. If you're in Eurozone or UK or Japan or other major economies, they have functioning currencies, functioning payment systems, and those currencies need to be on chain as well.
Yeah.
So, and we can't just yeah, a lot of the financial markets trade in dollars, but they don't all trade in dollars.
My
Um,
our friend
yeah.
Dave Birch, who was with us last week, he gave me the missing piece of the puzzle, I think, for me, and to go from emerging markets,
Mm.
right? And that the guys at Castle Island Ventures wrote a very good report. I think it was last year
Mm.
with Artemis, and we covered this on a podcast episode in the past. And to say that, listen, in emerging markets, stablecoins are working, and they're US dollar stablecoins, obviously. The majority of folks in emerging markets that are using stablecoins use Tether, and they're accessing that through Binance primarily. And the problems that stablecoins are solving, US dollar stablecoins are solving in those emerging markets, are that people can't trust their banks, they can't trust the currency, they can't trust the government. And so they prefer to live their financial lives in US dollar. Now, that is still a small drop in the ocean in terms of global GDP and global value of assets, but it's solving real problems. And the conclusion I came to after reading that Castle Island Ventures report called Emerging Markets or Stablecoins in Emerging Markets was that the problems that stablecoins are solving in emerging markets, those problems don't exist in Europe. And let's just take Europe, right? But Dave Birch got me thinking about this. If AI will become the dominant user of stablecoins, which is the expectation, and that there are other problems in the Western world or in developed markets to solve. People getting ripped off in insurance, people having 292 billion pounds in the UK, for example, sitting in savings accounts, earning nothing. So your AI agent, your bot won't stand for that. It will look to solve those problems and try to get you some yield on your savings and try to get you a better insurance deal. And stablecoins are the only way to do that efficiently because stablecoins are programmable and they don't wait for the banks to open on Monday because you can, they're 24/7 instant, fast, cheap settlement. And AI won't stand for that. It won't wait. It will just go. It will go. And so in a roundabout way, we're coming back to if stablecoins are the dominant way that AI transacts and AI will transact, and 99% of them right now are in US dollar, is European economic sovereignty or currency sovereignty threatened by people then using US dollar through AI, US dollar stablecoins? That's the question for me, right?
And
Is this,
yeah,
where are we headed?
yeah, I think there's two bits to unpack in what you said there. The first one, actually, before we come back to developed markets like Europe or UK, is emerging markets. So one of the other interesting things in the article was the risk that's being raised around dollarization in emerging markets. Like dollarization in emerging markets is not new. There's a piece here of, do we fundamentally forever undermine those countries' ability to have their own economic sovereignty? Because actually,
I think we
yes,
do.
there are countries where you don't trust the currency, but actually, do we end up in a world where everybody outside the G7 or outside the big currency blocks just uses dollars, and their local capital markets and their local central banks just get completely decimated? So obviously, I agree, it's solving a real problem in some of those markets, but is it also just then perpetuating and potentially a spiral? And that's one separate, like, that I hadn't thought of, because I'd be the same as you. I'd always go, this is working in certain places where people want to hold US dollars, they need faster payments, and even in the US, where payments are a bit slow. But we don't have those with money works in Europe. Now, coming back to the kind of develop to Europe as an example, or Europe particularly, UK, it's the same issue but probably less amplified right now. Europe is genuinely worried about payment sovereignty, about payment schemes. Let's ignore currency for a minute.
Yeah.
So if you now layer that you lose the currency as well, like that's, that's just somewhere I don't think Europe can go, and therefore, and it was kind of rewinding back. That means you need local domicile tokenized money.
I want that. I want to see Euro. I want to see Euro stablecoin liquidity. I think the one that Circle issued is at about 300 million right now, compared to 300 billion in the US dollar denominated stablecoins. We need more.
And I think it may be a bit easier to get it going. We may be obsessing at there's only 300 million liquidity rather than looking at is there sufficient liquidity to get in and out of it.
That's a really good point. That's a really good point.
How much liquidity do we need to actually, because we've got to create the flywheel. So you've got to create the usage, and we're in a bit of a chicken and egg. People are saying, there isn't enough liquidity, so we can't use it. Well, if you're not going to use it, there won't be liquidity. So it's kind of how do we break that chicken and egg? And obviously there's interesting things that separate to the article, the really interesting one is the European banks getting together to do a stablecoin rather than a deposit token.
Yeah.
Whereas the UK banks have gone down tokenized deposits. So it's kind of, I think we're still in that norming phase of where's this going to land.
I think it comes back to this, that we are still early, and I get so excited about these things. But if you have to think back to 2021, we were at 30 billion worth of stablecoins in the world. And now we're at 300 billion, and it's still just a drop in the bucket. And that Martin Wolf is basically saying that stablecoins will supercharge the dollar, that it'll weaken everyone else's currency. It won't fix the treasury market. It could trigger massive capital flight in emerging markets. It will constrain the Fed's policy tools, expose the world to Tether's questionable reserves, and leaves Europe stuck somewhere between sovereignty and competitiveness. Okay, so it's still early, Martin. That is my word to you. And we've got to remember here with the FT, you got to love them. They've been so anti-crypto, anti-stablecoins for so many years. So we're still early. And, what I take from this is that it's not just some domestic fintech. It is geopolitical battlegrounds here that people are thinking about. But we've got to explore. We've got to keep innovating. We've got to keep moving towards just enabling people to live their financial lives, and businesses to transact business all over the world, and financial institutions do so in a quicker, faster, better, cheaper manner, right? I think that's what we're looking at.
And I think we've got to, as innovators, also understand the other perspective of the central banks and why this is geopolitical, and why some of the things they do in regulations or talk about where we might go, why are you doing this? And you actually go, well, actually, they have something they're trying to protect as well. And
it's like 1996 all over again with the internet. We got to get that right. And listen, Garrett, thank you for unpacking this with me. Really appreciate it. And what's the best way for people to find you?
Find me on LinkedIn is probably the best way. Garrett Cassidy on LinkedIn. You won't be hard to find me. And Pete, thank you very much for having me on again. A privilege to be on the first of the new format.
Wonderful. Thanks so much, Garrett. See you.
Thank you.